Capm or capital asset model actually helps us to do two things: to pick correctly our stock in the portfolio and equally the evaluation of the stock. So basically those are the two primary usefulness of Capm, and it basically look at the risk-free rate and our risk premium. The risk-free rate and the risk premium, they are very key when we are talking about Capm determination to determine our expected return. So this is expected return. We want to work towards our expected return. We need to find what our risk-free rate is. So what is risk-free rate? Risk-free rate basically is telling us about the lowest of risk that an investor can go into, especially when it comes to governmental bond across the nations of the world. So they are risk-free. Take for example the tendency that the US will not be able to pay the debt, especially internal debt, is very slim. Likewise in the UK. So, and I just did a risk-free rate for the UK, and it's currently about 3.39. So you need to determine that, and for examination purposes it will have been given, and if it was not given, then it simply means that you need to quickly work on the aspect of what the current country's bond is saying, especially the yearly rate. That is your risk free. That is if the question allows that or give gap as to that. Then we talk about our risk premium. This is a risk premium, that is the difference between our market return and our risk-free rate, which we already know here. Basically, this goes historically, that is our market returns, and it can go as high as a decade or 2 decades to average it. Most likely in exam, if for exam purposes and you are not an investor, this most likely will be given. So now let's say we want to calculate our CAPM. Let's say for Apple now, we need to know our beta. Okay, I forgot to mention beta. When we are talking about beta, because we need to multiply our risk premium against our beta. Beta simply is telling us about the risk that is incumbent in that particular stock that we are about to pick. And basically we can have one, that is one as a beta. We can have the higher of one as a beta, and we can have the lower of one as a beta. So basically when we have our beta equals to, when our beta is equals to 1, is simply telling us that the risk factor in the stock, in that particular stock, is the same as the market. That is, put the market, the stock exchange, if that's what you call it in your country, put it together. It's most the same way the whole stock will move. So that means the same risk, it flows the same. That means it's equal. But if it is greater than, one, it simply tells us that that stock you are actually picking is a bit aggressive. Let's say for example, like that of Apple now is one, the beta is 1.28. It simply is telling us that if for any reason that the market become bullish, the stock will be more bullish than the whole portfolio that the nation has in a stock exchange in its capital market. That is what it simply means. And equally and higher of more than one is telling us that at the same time too, if the capital market is undergoing the downward trend too, the one that is aggressive can easily fall lower equally. So that is what it means. But if you have a beta for an organization you are looking at that is lower than one, now, it simply means that that stock is defensive, which by interpretation and implication simply means that if you buy into such a stock, if there is a bull trend, the stock may not peak equally as other stocks are peaking. But at the same time, if there is a downward trend, the stock will not fall easily because it's on defensive mode. Basically, that is the interpretation of our beta, and that is what beta. Having known that, if we are to calculate for Apple stock now, for example, we need to know our risk-free rate. Like, let's say Apple basically is a US stock, though they have some other regions. We have our risk-free rate as 1.28, right? Then we'll be talking about our beta. This is beta rather. This figure is for beta, so let me put it here, 1.28. We know our beta to be this. Let's say our risk-free rate, which I just checked for London, is 3.39. 3.39, pardon me for this handwriting. Okay, so we know our risk factor, our risk-free rate rather, we know our beta, and this equally we just come here and our market rates of return. Basically, we go historical, check for 20, 10 years historical value and average it. Ordinarily, you may not need to do this. The examiner will have given. That is if you are not practicalizing. I'm approaching it based on practical experience that you actually want to do it by yourself. Look for the factors by yourself. You get this. So let's say for any reason, this is, let's say 15% thereabout. So once you have this, then we can know what our CAPM, our expected return will be. You understand? So basically, like I said when we began, CAPM simply could be used for two things: evaluation of our pricing and of our return, and two, to determine whether to put a stock into the portfolio or not. Having established that, we have a graph usually that it follows. This is our risk region and this is our return region. This is our return region, this is our risk region, and generally the capital market we have is security market line, basically, which usually we follow the supply curve. That is, the higher, the higher, the higher, the lower, the lower. The lower the risk, the lower the return. The higher the risk, the higher the return. Okay, so basically then you will have an upward trend like we have. So basically this is CAPM graph. Having said that, now there is another important thing, especially if you are practicalizing it or for exams purposes. So let me quickly erase this and let us quickly have what we need to know more about: the interpretation of our graphs and the like. I want to believe that we must have taken one or two things out of this one as before I erase them. So having said that, now we need to understand one more thing about our graph. And now we have a scattered graph. We call it scattered graph. Those that are beneath the SML, that is security markets line below, they are overvalued. That is the risk, the return is actually more than the risk that is involved in the real sense of it, but they are not given the real price in the market. Don't forget that market actually has its own sentiment. So that those stock like that, they are good for to be examined and to be bought into. I actually meant to say that all the stock below are overvalued while those that are above are undervalued. Basically, that is how it works. If we look at this risk and we look at this return, recapping. And before I recap, from G. James Associate channel, for those that are just joining on, my name is Benga Olatunji FCA. We had loved that you subscribe to G. James Associate channel and like. That shows YouTube that you enjoy value and it will go to other people. If you do not like it, that simply means that maybe there is no value that you've enjoyed. That is what the algorithm will interpret it to be. So we would love that you like, you comment, and don't forget to click the subscription and click all notification so that anytime we upload new, you will be the first to be notified. Recapping quickly, we say when we are talking about Capm or capital assets model, is a model of pricing the stock in which we want to know whether we can buy and at what price, and what will be our return, which we call expected return. And to do that, we actually need to know what the market is giving us and what the risk involved in the stock actually is. Is it on the defensive or is it aggressive? We call it beta, that is the risk factor in that particular stock, which usually you can find on the stock exchange or even on the website of the organization that you want to buy into. Basically, if you've had followed us, you will get the calculation correctly if you are to calculate and the interpretation of what the graph simply says. From G. James Associate, we have value to life, we have value to your business.